Have you ever caught yourself thinking, why is the market reversing right now? Or where do these sharp upward and downward movements come from? Most people would say it's all about supply and demand, but in reality, prices are driven by a much deeper mechanism, the price delivery algorithm. In the last video, I showed how this algorithm works on Forex. Today, we'll move on to indices. To make it clearer and show you that this logic really works, I will show you how my trading day goes, how I build a scenario where I look for a trade, and how I open it according to my rules. After that, we will analyze each part of the algorithm in detail so that you can apply the same logic in your trading. Let's start with NASDAQ. In most cases, I prefer to trade this asset during the New York session, but preparation for trading always begins in London. Here I mark two local liquidity zones for myself, as well as zones of interest, in this case, fair value gaps at the top and bottom. I have two trading scenarios for today. First, if we withdraw liquidity from below in New York and reach the fair value gap, we'll get a reaction. Then I'll look for buys. Second scenario, if the market first withdraws local liquidity from above and gives confirmation, then the priority will be for sales. Now that the plan for the day is ready, I'm simply watching the New York opening. As you can see, the market first removes local liquidity from above. Formally, this was one of my scenarios for selling, but here it is important to understand. Liquidity sweep alone does not provide an entry point. In smart money logic, confirmation is always required on a lower time frame, a change in structure, and the appearance of a fair value gap. This time, no such confirmation appeared. The market simply withdrew liquidity and moved on without us. This is a normal situation. Not every scenario works out into a trade. For me, the second scenario remains valid. If the market withdraws liquidity from the bottom and returns to the fair value gap with a reaction, then I'll look for buying opportunities. Right now, liquidity is being withdrawn from the local zone that we marked at the beginning of the day. This is the scenario I was waiting for. The market is taking stops from the bottom, making room for a possible upward movement. On the lower time frame, we see a liquidity sweep. The price took the stops and left a reaction. I mark this zone on the chart. Now, the key moment for me is this. If the market reverses from here and closes above this area, I will open a buy trade. So, after liquidity withdrawal on the lower time frame, the price reverses and consolidates above the marked zone. This is where I open a buy trade. I place a stop behind the sweep tail, where the main volume of liquidity was withdrawn. I determine the target in advance. It's the nearest local liquidity zone above. As a result, the risk-to-reward ratio in this trade turned out to be slightly more than 1 to 2. This is not the maximum result, but the trade fully complies with my rules. There is a scenario, there is confirmation, and there is a clear plan with an understandable stop and take. I emphasize the importance of re-sweeping liquidity before opening a trade for a reason. As you can see, I made my first entry a little earlier, and it was on this sweep that I got a stop of $2,000. But according to my rules, if the scenario remains valid, I can re-enter the trade once. Therefore, after confirmation, I made a re-entry. It is important to understand one simple thing here. My goal is not to show you only profitable trades. In trading, losing trades are inevitable, and you need to know how to work with them. The key point is not to avoid stops, but to maintain the logic of the scenario and discipline. This is what ultimately gives a stable result. The price gradually reaches the marked liquidity zone and almost touches my take. The trade closes in the black. As a result, I had two trades today. The first closed at a stop. The second worked out according to the scenario and reached the target. The total result for the day was about $3,100 in profit. Now let's take a closer look. How to find such trades and how the price delivery algorithm itself works. The most important thing here is to understand the essence of the algorithm, not just repeat patterns. Before the start of each trading week, I always mark the key liquidity, the maximum and minimum of the previous week, as well as areas of interest. This is the foundation on which the entire scenario is built. Why these ones? Because last week's or even last month's liquidity, combined with the movement of the London or New York session, creates conditions for a strong impulse. And this is the first thing to remember. The market always strives for liquidity, and the tasks of the sessions help to understand how exactly it will take it. Now it's important to understand the tasks of the sessions. Each of them may have its own goal. Sometimes the market rebalances the movement. Sometimes it triggers the delivery of the price at a premium or discount, and sometimes it simply removes liquidity. For example, now on the chart it is Monday. So far only the Asian session has been active, and here I'm looking at the context on the higher time frames, H1 or H4. When London opens, I'm not just waiting for liquidity to be withdrawn. For a trade, I need the price to meet three conditions. First, liquidity withdrawal from one of the zones, then price delivery to a pre-marked zone of interest. In this case, it's fair value gap, only then confirmation on a lower time frame. If these conditions are met, the scenario is working and I can look for a trade. If not, then the session had a different task. and I just observe, recording the context. The logic is the same in New York, except that the liquidity of the London session is also added to the mix. Remember, not every session has to result in a trade, but if the price enters the zone of interest, removes liquidity, and provides confirmation, that is the moment when the algorithm gives an entry point. On this day, as you can see, neither the London nor the New York session saw the price reach the liquidity zones that we had marked in advance. The market remained in a fairly narrow range, and there were simply no conditions for a trade. In such situations, I don't make anything up. All zones of interest and liquidity zones remain on the chart, and I continue to work with them the next day. This is also part of the algorithm. Not every session has to result in a trade. Let's move on to the next day. The scenario remains relevant because on Monday we didn't see how the algorithm works with liquidity. Therefore, I start observing again with the Asian session and then switch to London. At the opening of the London session, the price simply falls, but here it's important to understand there is no reaction to the zone of interest. In such cases, I cross out this zone because the algorithm ignored it and immediately mark the next one, where delivery can logically be carried out. I do the same with liquidity zones. I remove irrelevant ones and update the markup. Specifically this week, the next zone of interest is the fair value gap area, from which the price has already reacted several times. Therefore, I assume that the algorithm will again lead the price there. Many people in training videos say that the fair value gap only works on the first reaction, but this is a huge mistake. If we consider the price delivery algorithm as the work of large players who need to buy cheaper and sell more expensive, then the point is to bring the price back again and again to a protected zone where you can take a profitable position. That is why such zones can work more than once. This is where a potential entry opportunity is forming for me. To open a trade, I need to see a specific sequence of algorithm actions during the New York session. First, the price must withdraw liquidity from the London session. Then, it must withdraw the next local liquidity, and then enter the pre-marked zone of interest. That's exactly how it happened. So it's a signal to me that the scenario is developing in the right way, and the trade could be a good one. Now I switch to a lower time frame and start looking for confirmation to enter. On the 5-minute time frame, I have an order block forming and a fair value gap zone nearby. To enter the trade, I'm waiting for a pullback to the 0.5 order block area. From there, I plan to open a buy position. At the same time, it is important to understand that the fair value gap itself remains a valid entry scenario. In smart money logic, both options are viable: entry from FVG or entry deeper from the middle of the order block. As a result, this trade brought me about $20,000. As you can see, it's all quite straightforward. The main thing is to understand what to look for and how to read the algorithm. This price movement logic works in any market, but each asset has its own nuances. For those who trade crypto, I've analyzed the algorithm in detail specifically for the crypto market. The link is in the upper right corner. And since we're talking about crypto, if you trade it, I recommend checking out Evedex. It's a decentralized exchange with full control over your funds. No intermediaries, no account blocking, and no KYC. Connect your wallet, MetaMask, Trust Wallet, or others, and start trading. Commissions are lower, the interface is on par with top centralized exchanges, and leverage of up to 100x is available for those who consciously work with risk. Fast, convenient, and anonymous, exactly what an active trader needs. The link to Evedex is in the description. And if it's still difficult to apply all this logic, you can start with something simpler: the OWL indicator. It's not about liquidity and smart money, but about a trend-based approach with clear risks, entry zone, stop targets, no manual marking. Based on the OWL signal, I recently made a BTC trade that brought in about $5,000. The link to the indicator is also in the description. So, the main conclusion: the market never moves chaotically. Each session has its own task: rebalancing price delivery or liquidity withdrawal. If you understand this logic, it only works when the price enters the zone of interest, withdraws liquidity, and gives confirmation you have a system. The smart money approach is a process: observation, scenario, confirmation, trade. This approach removes chaos and turns the market into a sequence of actions where you understand why you are entering now and where your risk lies. Yes, there will be stops, but discipline and working according to the algorithm make the results stable. That is why we trade not what we want, but what the market itself confirms. If this video has helped you see the market in a new way, like it, write in the comments what you think about the logic of price delivery, and subscribe to the channel. There will be even more trade analysis and practical scenarios ahead.